will Elon give mercy to the S&P? So, first of all, we want to say, mercy, mercy me, things ain't what they used to be by Marvin Gaye is my singing musical tone for the day. I'm in Charlotte, North Carolina, and we'll show you our location better. The Renaissance Hotel is where we're at. I wanted to review with you what we think is an interesting problem going on as we head into the S&P entry of Tesla on the 21st of December. So this show's structure is going to be focused in the first half of the show up to about 8 minutes on sort of the history of investing process, and then after that we sort of move on to what's going on now, what's going to happen in case you want to fire forward, and then we're going to have our usual health tips that we usually go through. So what's going on right now is a very, very interesting circumstance. So there's a concept called value investing. So if you look at on our screen or below this screen, you'll notice that we've listed a gentleman named Peter Lynch and a book called One Up on Wall Street. Well, Peter is considered, he was the head of the Magellan Fund, and he kind of started it, I guess, when it was $10 million, and he grew it to perhaps the largest fund in the world, and the returns that he was offering investors is what drove people to truly get after and own those shares. So today there's this very interesting problem that's come up, which is, so we've been kind of talking about this for a while, but the problem that comes up is, how do you manage Tesla as an investment if you're an investment manager? The problem that's happening is, sort of think about the raw numbers. Tesla maybe has 4 factories, call it that, and of those the primary production or all the production is between Shanghai and the facility in Fremont. And then the problem there is that they're only producing, in theory, 500,000 vehicles a year, but obviously the valuation is huge. This is a reflection of the growth potential of the stock. And the flip side of that, if you really want to say, hey, Tesla could go out of business, you'd take a look at the opposite side of that discussion, which is, now wait a second, Mercedes-Benz, all of the companies in Japan, for example, are combined market cap worth less than Tesla, but they actually produce way more cars. So this is reflective of the problem of valuations related to growth rates and size of market you're growing into. And Tesla has really enjoyed this space a great deal, obviously, with a $500 billion market cap right now. So if you look in Peter Lynch's book, he really talks about, in the idea of value investing, is you kind of determine the growth rate of the company. And if you're buying it, you're trying to buy it at a price that's lower than its growth rate. And that's when it's a value. So when you see pullbacks on Tesla right now, you're seeing buyers get in there and purchase. And it really addresses the core idea that Peter Lynch has taught, which is what are the fundamentals of value investing and how do you implement that successfully over time. And obviously those of you that have made money on Tesla stock have been smart to get in. But one of the things that's a constant theme for Tesla is, how can you guys be buying the stock when it's exceeded its theoretical valuation by a wide margin? And then the next question is, how can other people be buying it after you guys already bought it before? And so it introduces these really interesting questions about value and how you manage. And it also goes back to a big discussion that's going on, which is when you're dealing with technology circumstances where software or other companies can grow up very quickly, Amazon, Microsoft, in this case Tesla, and all of a sudden validate their market cap with what they do in the marketplace. How do you actually put valuations on this so that you can advise investors? So the answer that people have come up with is what we just saw from Morgan Stanley. Morgan Stanley just came out with a number on what they thought Tesla was worth. Let's say it's $600. But the bull case, I guess this in case is Wedbush, they came up with the idea that the bull case on Tesla is $1,000 a share. So everybody else is in that, $560, $580, maybe $600 zone, but Wedbush is up around $1,000 in its bull case. So you would say, okay, in the normal case, it's a $500 to $600 stock. In the bull case, it's worth $1,000 because there are a number of initiatives like autonomous driving, like the entry into the semi world, all the, what's going to happen with the Cybertruck. There are all these entities that represent an opportunity for the bull case on that company to be felt. So this is a fascinating circumstance because it really forces a lot of people out of their comfort zone of how you sort of think about and implement what's called value investing, which is the most core idea for how stocks are, and perhaps even bonds, are valued. So how does this all relate to the whole question of kind of what's happening with Tesla right now and how are we doing heading into the S&P? So the answer to that question is that there's this interesting problem that's sort of popped up, and that is that the numbers are a problem. So there's a game called musical chairs, and the way the chairs work is that you start out with a certain number of chairs. Let's say you have 5 chairs and 5 people, and then the people walk around the chairs, and then everybody can sit down because they're 5 and 5. But what happens when you have 4 chairs and there are 5 people? Well, if you're in the right spot to sit down, you're a winner because now you can sit down and everything is cool. The problem, though, that's popped up with this whole plan is kind of how there's a musical chairs thing going on with Tesla stock. And let me explain. Number one, if you just look up Tesla, like under Google, type in Tesla, and then look at who owns the most shares and how the shares are allocated. So there are people out there like Ron Barron, for example, he's a buy and hold guy. There's Elon Musk, obviously 20% of shares, and then his homeboys, probably another 3 or maybe even 5% of shares. So the way the numbers are working is if you have institutions owning 60% of Tesla's shares, Elon owns 20, and then a number of people like Ron Barron and those guys own another 3 to 5%. Theoretically, 85% of the shares are in the hands of people who have no incentive to sell. Now, it's an interesting situation because think about Fidelity. So Fidelity has technology funds, they have S&P funds, they have funds that deal with big cap growth. There are all these different types of funds that people might invest in. Well, there's an interesting conversation going on between Mr. A and Mr. B. Mr. A is a S&P manager for Fidelity. Mr. B is a fund manager, let's say, for technology growth, which Tesla would actually hit, or maybe even automotive growth or big cap growth. Tesla hits a lot of sort of zones that people have to invest in. So then Mr. A says to Mr. B, well, right now, to fit our allocation of how we need to be weighted relative to the S&P, we need you guys to sell us some of those shares. And so Mr. B is like, well, wait a second, in order to do our big cap growth thing, we need those shares too. So you have these two people that are having a really interesting conversation, which is Mr. A, who needs those shares, is saying to Mr. B, what price is it that we have to raise to that's going to show up in the market to get you to get up off enough shares so that we can get our allocation that we need. Now, this is a really difficult question and answer session that we're going through right now. And the reason is that because Tesla is in so many indices, like the value growth, big cap growth, automotive growth, the NASDAQ 100, which is where most of the growth is for stocks. There are all these different funds that need to both have and keep their shares. And in theory, there's probably a number that we can get to where they capitulate and say, look, this thing has gotten so expensive that even though we're required to have them as part of our fund because of how they hit certain indices, we're going to have to sell out and hand over those shares to you, with the handover price being consistent with what the market is saying. So the question that comes up is, what exactly is that number? And this is a really interesting problem, because right now, in theory, you only have 15% of the shares that are left over for these guys to acquire enough volume to make, to be compliant with the S&P. So the answer to how this is working is the S&P made the comment, okay, we'll just delay by a month instead of a week when we allow Tesla to enter. This would allow managers to get compliant with their S&P agreement, and we'll be good to go. Well, that's actually a really good idea. The problem, though, is there are not enough shares to go around for all the people to get compliant in the circumstance I just described, for the reason I just described. So what's S&P's answer to this? Well, their answer was that, hey, why don't we just put a call out to as many people as possible to help us to figure out this conundrum. So that's exactly what they did. So the answer to how this is going to work is where we come up with, mercy, mercy me, things aren't what they used to be. The answer might be that Elon says, hey, we need cash to build a semi and other things anyway. Why don't we issue more shares, therefore giving the fund managers an ability to have the shares they need to execute what they need to do. Yeah, that's going to hurt the stock price and it's going to dilute a bit, but it's also going to make this more efficient. So the question mark is, Elon's a pretty stubborn guy. What is Elon going to actually say and do in this circumstance? Is he A, going to say, hey, tough luck, I'm not going to do anymore? Like split the shares like he did, or issue the $5 billion that he did to sort of help this whole thing work properly. Because, he did his share basically. So the next question is now, wait a second, what are the other options that the S&P has? Well, I think they have the option of just sitting there and watching the fund managers try to battle this out. They have the second option of a second round of discussion, negotiations with Elon. There's actually a third option that's lurking, which is, what if the price of the stock gets to such a crazy level, let's say $700, $800 a share, and its gap between its growth rate and the price of the stock is so large that we're in this totally unknown zone of pricing. What if the S&P says, well, look, we tried to work with you, Elon. We want you in the S&P, but you guys are being so stubborn, we're going to take you out of the S&P until we can figure this out. And so there's no need for us to rebalance from what we currently have. Well, that would be a very bad news scenario, because as of right now, perhaps $150 worth of the share price of Tesla is related to that entry into the S&P. What if the S&P with the managers have to capitulate and say, the shares are just not available? I guess the one other option they have is perhaps to do a special case for Tesla and its share situation and just reduce dramatically down to where they are now, what the weighting of Tesla would be into the S&P. Supposedly, you could just say, we'll give you 6 months to a year to comply, and then you guys figure it out. I suppose that's another option that's on the table. So I'm actually hopeful that the S&P doesn't do the Death Star move, which would be to say, Elon, you're not cooperating. We really want you in, but given your structure, we don't see how this works. So I have to go back to the fact that John Bogle, runs one of his funds, sort of is the biggest S&P fund, I think $2 or $3 trillion. And even he has the problem of the fact that he has different types of funds, and he has to get shares to get S&P compliant as well. And he can't just get those shares from other funds within his organization, because the transfer price has to be market price. So there's this huge question mark about how this is all going to play out. And the answer to it, we're going to find out what it is, but at current, we have no idea what the answer to this question is going to be. And it's amazing to have the S&P start soliciting outside experts to help them figure out what to do, because it really shows that we're in unknown territory caused by the success of Tesla, the size of the company as it enters, etc. So stay tuned, folks. This could get wild. And what I mean by wild is the only way that this thing works out right now is something called supply and demand. If there's limited to supply, at what price can we get you to get up off your shares? And if your answer is we ain't getting up off, the next question is going to be, well, how about 20 bucks more? How about 50 bucks more? How about 100 bucks more? To really force your hand to try to get those shares out of your hands. And so that hasn't happened yet in terms of uncle in this regard. And so today we're seeing a nice increase. Pre-market of the stock was like $8, but we had this whole routine of early morning pre-market jump in stock price, $5 or $10, and as we close towards the open of market, it jumps $25. And so the day's run is a $30 to $40 up for the stock. And we've sort of gotten into this pattern the last few days, and congratulations to you if you're making good money. This whole thing is sort of unprecedented, and I think it's going to it should result in some very high prices for the stock over the next few weeks. But there's also a little bit of unknown because of some of the things that might be decided in terms of what the solution to this sort of short squeeze of shares might be. What do I think is going to happen? That's a great question. The only thing I can see is the classic economics of supply and demand, where there's not much supply and the price has to keep rising until you can force people to finally capitulate and say they're going to give up their shares. But Elon ain't giving up his, and a lot of the funds ain't giving up theirs. So I really think that the price could keep going higher, and very few shares will come to market because everybody knows that this whole thing is horrible for supply and demand. And why would I want to give up my supply when I can keep getting better prices all the time? So stay tuned. You are now in uncharted waters if you're an investor, because we're going to see some really crazy things happen over the next few weeks. And we hope that you're actually able to make some good money off of it. Wanted to remind you, we do have some trade consulting that we're doing. Please sign up on our Patreon at any level if you'd like to learn about options trading, etc., and have some consulting assistance with your trading. I think you'll find it to be very profitable to get the support as we work through this period. Any rate, this is going to be fun. I'm looking forward to all of your comments. The next thing I wanted to review today is just our usual health tips. The first one that's burning in my brain is there's a lady who's a cardiothoracic surgeon who I had a chance to sit in on a lecture with last year. And she made a comment to me which sort of changed my life, in that she said, look, there's something called bacon. And if you like bacon, that's good. You're allowed to have it on Christmas and on your birthday. So it kind of froze me up because I'd like to be healthier, and we cover this a bit. So I just wanted to let you know what she said, because I didn't, after she said that, it kind of froze me. And then my consumption of bacon is dropping dramatically, and I think I'm healthier as a result. It's been a year of testing out her concepts, but I wanted to know Christmas is coming up, and when my bacon option is open, I'm going to enjoy, and I'm going to enjoy on my birthday as was described. So that's one of our diet tips for the day. The next thing that I wanted to review is don't forget your 25 leg lifts per leg to strengthen the quad muscles. Number 3 is I want to encourage you to consider the 5-2 or some other fasting diet. 60% of the 200 doctors we survey are doing some kind of fasting. I suppose the best one I like is only eat on a 12-hour side of the clock and no other, and not for the rest of the day. Giving your body a break, digestion, etc., is in better shape. Also wanted to encourage you to only do fried foods once a week. Also wanted to encourage you to some exercise in terms of walking 15 minutes a day can actually be really helpful. I wanted to start a process of introducing sort of places I'm at and food that's here and things like that as a back end of our show. I'm currently in Charlotte, North Carolina. I'm at the Renaissance Hotel. I wanted to, we'll show you some video of the area as we're closing out here. As you can see, it's a really nice lobby area. You could hear the water throughout our presentation. I have to admit that my favorite restaurant in the whole city is a place called Mac's Speed Shop. It's a barbecue place, and it's great because your meal is $10 and it tastes great. Good parking at the location I go to near Uptown, and I've eaten there maybe 8 or 10, or about 8 times, and excellent service, excellent food, great price, good parking location, just a lot of appealing elements to it, and I wanted to mention it to you in case you end up in this zone and wanted a great place to eat to consider. Any rate, I think that's about it for today. I wanted to thank you again for joining us. Please remember to like and subscribe. This is Greg for Teslafaninsight. Tschüss, au revoir, French, Lehithro, Hebrew, Khoda Hafez, Farsi, Assalamu alaikum, Muslim, Ohio gozaimasu, Japanese, Zdravstvuyte, hello in Russian, Ni hao ma, hello in Chinese, Namaste, India, or Hindi, Dobijania, Polish, and Hey Do to our friends in Sweden. And in Jamaica we say, enough respect, walk good man. Thanks for joining us for the day. We look forward to your comments, and if you know of cool places to eat in Charlotte that you'd recommend, we're open to it. Have a great day, and bye for now.